Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines this afternoon. Indian markets come off record highs as stocks across Asia fall. Sensex and the Nifty trading lower this afternoon.
Amber Enterprises has a good debut with the stock gaining more than 45% over its IPO price at 859 rupees per share.
The country's largest dairy company bets big on India eating out. Amul MD tells Bloomberg Quint the aim is to get 25 to 30% of its total revenues from restaurants and caterers over the next 5 years.
And homegrown cab aggregator Ola looks to step outside the country, announces plans to start operations in Australia.
Higher inventory is expected to help Indian Oil Corporation offset some of the impact of rising crude prices in the third quarter when it reports results today.
But let's take a look at how the markets are faring. It's weakness across the board, across Asia really today. There is nervousness creeping before the big event, the budget that's ahead of us in the next couple of days. Neeraj is here with a closer look.
Yeah, that pretty much sums it up, really. The activity across the rest of the world is weak. India's weak too. VIX too came off a bit in the session today. So volatility just showed the first signs of ebbing. If you pull up India VIX, it'll show you 2.5% down, 17.49, still at elevated levels, but down about 2.5%. And frankly, barring one or two specific names, and if you pull up the Nifty losers list, you'll see that the large portion of stocks have gone out. The market started off with a fair bit of red, and even stocks like Tech Mahindra, which came out with a decent set of numbers, started off very, very weak. So there weren't any big winners at the start of the trading day. Broader market started off weak, about 0.5%, and have only worsened. And I would guess that the market breadth or the advanced decline ratio currently trading very close to or at the low point of the day. So pretty much a mirror image, quite frankly, of what happened in the last 45 minutes of trade yesterday. Just that, yesterday the market breadth looked like this at the fag end of the trading day. In today's session, it's looking wobbly throughout the trading session, but not surprised there. The broader markets have been weak and they continue to look weak.
All right, Neeraj, thanks so much. That's the quick check on the markets. Let's move into individual news coming in. KPIT Technologies has announced a merger with the CK Birla Group-owned Birla Soft to create a $700 million entity. Shares of KPIT Technologies, though, fell after the company set 182 rupees as the price for the open offer. Yatin Mehta standing by with details of the deal and also what brokerages make of it. Yatin.
Well, if you look at KPIT Technologies, the shares have now rebounded almost 10% up from the day's low. Clearly, if you look at a few brokerages, they have been bullish as far as the entire merger transaction is concerned. The transaction is basically the merger of KPIT as well as Birla Soft, which will be then, after the merger, will be demerged into two separate entities. One will be the IT services business, which will be controlled by the Birlas, the CK Birla Group. And second will be the engineering business or the engineering solution business, which will be controlled by the current KPIT Technologies promoter. And before this transaction happens, we have the shareholders of KPIT Technologies, which will be eligible for a 26% open offer, for which the price has been set at 182 rupees per share. And if you look at the merger contours, 9 shares of Birla Soft will fetch 22 shares in KPIT Technologies, and the entire transaction would create almost 7.66 new shares. So that will be the fresh equity which will be generated because of the merger transaction. And if you were to believe the Access Capital report on KPIT Technologies, they say that the intrinsic value of KPIT Technologies post the transaction would be close to 312 rupees per share. And probably that is the reason why we are looking at some good traction which is coming in the shares of KPIT Technologies, because they say that the Birla business has been valued at much lower multiples despite higher growth. And if you look at it from a combined entity perspective, the fair value assigned to the shareholders of KPIT Technologies is close to 312 rupees per share. But let's hear out the management of KPIT Technologies, which joined us earlier in the day, as to what the deal really means for the business as well as for the shareholders.
The current KPIT shareholder for a very short period will get diluted because of the merger of Birla, because Birla Soft into KPIT. As I said, the KPIT business of IT is about 350 million plus, about 360 million. Birla Soft will be about 140 million plus. So in similar, naturally considering their profitability and other ratios, Birla Soft is a little more profitable. So based on this working, there will be some dilution there. And later on, every shareholder in KPIT will get one share in KPIT and one share in engineering. Exchange ratio, what it works out and etc. will share later, but it would be anywhere between ratio of about 20% to 25%.
Okay, that's the KPIT story. Let's move on. We're watching out for Indian Oil Corporation's earnings today. A state-owned refiner is likely to report a hit in its margins. Samit is standing by to tell us what the street is anticipating. Samit.
So on a standalone basis compared to the last quarter, Indian Oil Corp is expected to report a good set of numbers. Now, revenues are expected to be 24% higher to around 1,12,429 crore rupees, while EBITDA is seen 28% higher to close to 9,400 crore rupees. Margins also would marginally expand to 8.4% versus 8% in the last quarter, while net profit would be 29% higher. Now, gross refining margin, that is the key number for an oil marketing company, is expected to come off a bit to around $7.4 per barrel versus $8 per barrel reported in the last quarter. Now in the third quarter, it will be the higher inventory gain which will play out for the oil marketing company. In fact, it will also offset the weaker refining and marketing margins of the company. Now the gross refining margin is however expected to be weak because the Asian benchmark, that is the Singapore gross refining margin, was also a bit off in this quarter compared to the last quarter. On the marketing side, if you see, the gross marketing margin earned on sale on every liter of petrol and diesel was also a bit off in the third quarter of financial year 2018 versus the Q2. Now this fall could largely be attributable to the lack of increase in the retail fuel prices because of the Gujarat state elections that were seen in the third quarter. On the operation side, however, the refinery throughput is expected to increase because of the contribution coming in from the Paradip refinery. Now throughput is expected to rise by around 13% to 18.2 million metric tons in the third quarter of financial year 2018. Also, the sales volumes are expected to rise, and the petchem segment is expected to rebound, and the contribution to the EBITDA of Indian Oil is expected to rise significantly. Now in the second quarter, it contributed around 14%, but in the third quarter is expected to see a bigger contribution to Indian Oil's EBITDA.
All right, Samit, thanks so much for that. That's Indian Oil and their earnings that are anticipated. Unitech may have had some temporary relief. The government has decided to withdraw its plea at the NCLT seeking to take over the company. This comes after the builder claimed it had inked a deal to sell land worth 400 crore. Actually, more importantly, this comes after the government acknowledges that it was perhaps not correct of it to go to the NCLT when there was another case pending in the Supreme Court. But Arpan Chaturvedi joining us on the phone line with more details. Arpan, what transpired today?
That's right. So basically this happened on the last hearing, which was on 12th January, and this information is from the order that was uploaded, and we managed to get access to the order on the Supreme Court website. So basically what had happened in December, if you remember, the central government had filed a petition in the NCLT alleging that there was mismanagement in Unitech, and on grounds of that, they sought that the NCLT should suspend the board and allow the government to nominate certain members on the Unitech board. Of course, the NCLT had allowed that petition and asked the government to suggest names. Post that, when the matter came up for hearing in the Supreme Court, the Unitech's counsel said that NCLT order was a violation of the Supreme Court order, which said that until the Supreme Court is hearing the Unitech home buyers case, no other forum should entertain any petitions. After that, the next day of that hearing, the Attorney General himself appeared in front of the Chief Justice of India, and he said that he acknowledges that point and he apologizes for this the petition that was filed. Post that, of course, the Supreme Court had granted a stay and had stayed those NCLT orders and proceedings. Now, after this is what now basically after that, in the last day of hearing, the government counsel Rajat Nair informed the court that they are going to withdraw this petition for taking over the management of the company, which was filed at NCLT. And after that, of course, the matter now stands disposed of.
All right, thanks so much for that, Arpan. That's Unitech, the stock trading about 1% lower. Just news, a little bit of news coming in from State Bank of India. The bank has decided to increase its interest rates on high-value deposits. They have been slowly adjusting their bulk deposit rates upwards. The latest increase has been by about 50 to 140 basis points in different buckets. All of this is above 1 crore, so all in the bulk deposit category. 2 points to note here. One, of course, SBI had cut its bulk deposit rates extremely low during the demonetization period. period was well below market rates, so it's adjusting its rates in line with the markets, but also the easy liquidity period is now over. Deposit growth has slowed, but credit growth has picked up, and as a result of that, the incremental credit deposit ratio has started to pick up, which gives enough reason to banks to actually hike their deposit rates. A report coming out from ICRA as well talking about that, and they say that the need for higher deposit mobilization and the trend of increasing deposit rates is clearly visible in the bulk deposit segment, with the surge in volume of certificate of deposit outstanding, as well as the increase in the minimum certificate of deposit rates during the last quarter. Banks with higher proportion of bulk deposits have already undertaken a hike in deposit rates in January 2018, although it remains limited to a few banks.
Okay, let's move on to some IPO action now. Amber Enterprises made a stellar debut on the bourses. The air conditioner maker listed at a premium of more than 300 rupees on its issue price. Bloomberg Queen's Ridhima Saxena caught up with Jasbir Singh, chairman and CEO of the company, and he says the focus remains on improving working capital and reducing the risk of client concentration. Listen.
So net working capital cycle days, today stands at 29 days, and we've, there's a large part of operating leverage which has come in because creditor days have increased, debtor days have a bit reduced. Absolute terms inventory same, and it has come down from 64 to 29, and we are expecting some better growth in that number this year. I think we are targeting positive towards 29, on the lower number.
Going forward, considering that the return on equity has suffered because of the long working capital cycle, once you improve it to 29 days, by how much do you see the return on equity in the next fiscal ones?
See, as I told you, there's a lot of operating leverage coming in. We've already reduced from 64 to 29. And, ours is a modular capex cycle, where entry barriers in our sector is quite high. So we think that, we are going for a betterment on this number. And largely, the return on equities will be, if you see my H1 results, it demonstrates that we are already progressing well. So in H1, we've delivered 27% top line growth. And PAT, we've already achieved what we achieved in the complete final year last year. So ROEs have, on a run rate basis, they've already touched 16%. From last year 9%, and we are definitely looking into a better operating leverage which will cover northwards towards this number.
So one last question on client concentration. So most of you talked about customer expansion in the first answer itself. So most of your clients, it's the top 10 clients that you get most of your orders from. So how do you plan to diversify that and increase the clientele, especially take a little more from the top 10 and give it a little more to the top 20 or something like that to reduce the risk of client concentration?
So we've worked on client concentration in last 7 years. We used to bank on one customer to a tune of 76%, and that customer today contributes only 9%. So none of our customer today is more than 22% banking on single customer. So we keep on, that is very much in focus. And, the endeavor is, one, to increase the wallet share in every customer by cross-selling different products and giving more comprehensive solution to customers. And second is that bringing in new customer at all. So that also, whole put together, if you see, it converts into nice client concentration. So we are not banking on even one single customer. So we are serving 8 out of top 10 brands today. And we continue to bring in more customers. Exports are also looking positive now to increase. We are getting good inquiries from nearby region. So that also will definitely complement the client concentration part.
All right, on to the unlisted space. India's growing love for eating out has got Amul thinking. The country's largest milk cooperative is now turning its focus to the restaurant and catering space, an area which currently contributes less than 10% of its total turnover. Charlene D'Souza caught up with R.S. Sodhi, managing director at Amul, to understand how the dairy company is changing its strategies. Charlene, what were the key takeaways from the conversation?
Amul is now focusing on increasing its revenue from the hotel and catering segment, which is growing at 10% per annum, and it's expected to hit 5.5 lakh crores by 2022. The dairy major, which predominantly caters to the retail audience, is now looking to bet on the urban Indians consumers love to eat out of home. I caught up with Amul's Managing Director R.S. Sodhi. Listen in.
You see, HoReCa segment, hotel, restaurant, catering segment, today average Indian, as the incomes are increasing, they have started eating out more. Even any function, any marriage, you see lot of value added food products are now added. So that segment is growing. Today, if you see our earnings or our sale out of the HoReCa segment may be around all India level, maybe 7 to 8%. In some Bombay like it may be 18-20%. Average is 7 to 8%. But we expect this HoReCa segment to contribute minimum 25% to our kitty.
By when?
25%.
By when?
In another 5 to 6 years. Because we were not concentrating. Frankly speaking, HoReCa segment we were not concentrating because whatever we were able to produce, it was selling in the general market. But if you talk about developed countries, HoReCa segment is contributing 50% to the dairy. Leave aside milk, all other value-added products. So we expect that besides milk, all other product category, 25% will come from the HoReCa segment. So for that, we are developing specific HoReCa products, specific HoReCa distribution network, and naturally HoReCa pricing also, and in which we are very good.
So you're more competitive because there are a lot of very private players who are present there.
We are competitive because Amul philosophy is there. Value for many, value for money. Value for many means 3.6 million farmers. We give them the best price for their produced milk. And value for money is for the millions of consumers to whom we provide best quality, tasty product at most affordable price. So why a HoReCa buyer will not buy Amul product?
Okay, that's Amul for you. Capacity constraints will restrict air traffic growth in India, says CAPA, the aviation industry think tank, that says that it expects more than 150 million people to fly each year by 2022. Purva Chitnis, who's at the event, joins us with the details. Purva, how much does the industry really need to grow to achieve that number? What's the forecast?
Yes, speaking about the domestic air traffic growth, CAPA said that in FY17 it has crossed 100 million and for FY18 it expects to cross 125 million. For FY19 it expects the growth to hover around 18 to 20%. However, this guidance has been cut at least by 2% owing to the major capacity constraints at the airports. Now moving on to adding new fleet, CAPA expects that around 130 new aircrafts would be added in FY19 owing to the strong domestic passenger growth, where Indigo would be the leader, whereas other airlines would also continue adding fleet. Moving on to crude oil prices, CAPA expects it to stay around the $70 per barrel mark. However, Ajay Singh said that this isn't a major concern until it hits $80 per barrel. And talking about the privatization of Air India, CAPA expects the major airlines such as Indigo, SpiceJet, Vistara to show interest in Air India. However, Ajay Singh of SpiceJet said it is too small a player to bid for Air India.
Okay, Purva, thank you for that. Let's move on now. The Chief Economic Advisor expects the Indian economy to grow at 6.75% this year and between 7 and 7.5% next fiscal. While this is the setting, is this setting more achievable? Fiscal targets, while this were the headline numbers from the economic survey yesterday, Arvind Subramaniam also spoke of a range of issues from impact of climate change on agriculture, jobs, insolvency, and power packs. He also spoke about the need for timely justice and even stigmatized capitalism, as he called it, prevalent in the country. Alex is standing by and he's pulled out some interesting charts from the CEA's reading of the economy, particularly on these aspects.
Absolutely. Well, Harsha, some of the points that you referred to make for really interesting reading, particularly the one on climate change and precipitation. I don't have that here with me. I'm talking about a few other charts. The first one I'm starting with refers to the bond market and the stock market. And what you can see on your screen essentially is the movement of the BSE Sensex, and this is essentially the 10-year price. This is the old one, by the way, moving into what it is currently. what is essentially pointing at is the divergence between the two and the fact that you don't often see it. The reason that the survey points to is that the stock market investors are bullish about the prospect of growth, while the bond market investors are a little wary of fiscal slippage going into the budget especially. Now, the next one that we have for you is fairly self-explanatory. It's the number of new tax filers, and you can see that there's a clear jump in the recent past that we've seen. The attribution to that is to demonetization and the implementation of GST. Moving on to the next one, you're talking about agricultural growth, a real agricultural growth and a real revenue here. Essentially, they're saying that it's remained constant over a 4-year period, and the reason why they say that is that 2 of those years, the monsoons have not been particularly good. The next one is on formal payrolls. This is essentially data. I'm going to essentially scrunch that up for you. We've talked about it in more detail, but what they're saying is looking at the data slightly differently from the perspective of the number of firms that come under the GST tax net. You essentially have a much larger number of people in the formal payroll non-agricultural segment than was previously thought. If you essentially put all of these numbers together, which amounts to 11.2 crore, and the number of people that are employed by the government, the total takes it to around 53% of the non-agricultural workforce. The next one talks about cash in circulation, and very clearly, if you look at the numbers pre-demonetization, this is where you see the sharp dip. This is where it is currently, and it's the difference here and the impact of what is being pointed to with regard to demonetization is that the cash in circulation is about 2.8 lakh crore less than what it was at the peak, and the number of high denomination notes has also come down. In terms of value, it's lower by 3.8 lakh crore. And the final one, the last one that I have for you, will probably have all the lawyers in the room smiling into their sleeves, because it's essentially pointing up the increase in the spend by corporate India on legal fees. So it's essentially gone up significantly. This, by the way, is in 1,000 crores. Back to you.
All right, Alex, thanks so much. Just 5 or 6 of the most interesting charts that the economic survey is full of. Now, we spoke to a lot of experts on specific issues. Rajiv Kumar, Vice Chairman of Niti Aayog, spoke to my colleague Tamanna Namdar late yesterday, talking about the employment issue. What should one read into a higher level of formal non-farm payrolls? Listen in.
If it is possible for us to have, at this point of time, small entrepreneurial startups which will earn an income for anybody, I don't see why we should resent or refute that. So I don't know where the debate is. Yes, it is a fact that our young people, their aspirations are running sky high, and they want to improve their living standards as rapidly as possible, and that is what we should be prepared for. But no doubt that this can be a first step in a young person's journey to become self-sustaining in a situation where he or she is not being able to afford higher education or vocational education as yet. And that's the other part of it, which is that we must now have a very good look as to how we open up our vocational and other technical educations, so that they can become, they can adopt a flexible, approach towards giving these skills to people who might be earning some things on a part-time basis, but yet also want to continue to improve their skills for a better prospect, in future.
So which brings me to the question of what can be done in the scope and within the scope of the budget, because this government has launched the Mudra scheme, the Startup India scheme, the Stand Up India scheme, and perhaps these things have longer gestation periods. But what can be done at this point?
Couple of things in my view. One, I think the budget could replicate and extend what has been done in the textile sector, which is or the ready-made garment sector, which was announced a package of 6,000 crore, I think, about a year and a half ago, essentially in the form of, if you like, wage subsidy for the employers of those who are exporting garments and who are putting up units, units. So if this could be extended to other labor-intensive sectors, that would be a good relief. Because in our country we have converted, because of our own specific situations of human rights and democracy, etc., and trade unionism, our surplus labor into a costly labor. So therefore, for our exporters and to remain globally competitive, and also for other industries, we need to bring down the cost of labor, which in other countries, like for example Germany or China or even Japan, is subsidized indirectly by the government providing cheap housing and health and education, which is all a part of the worker's consumption basket, but for which she doesn't have to pay from his own pocket. Now, to be able to remain competitive, our industries should also have access to similarly cost wage labor. So this is what the budget could do, to extend the textile package to leather and handicrafts and carpets and maybe even light engineering, wherever the finance minister thinks he could generate jobs more cheaply. And the second thing that the budget could do is to promote and incentivize apprenticeships in our industry, which is really which has really been missing in our country. And many countries have actually taken recourse to providing, to promoting apprenticeships in industries for generating tomorrow's jobs, on a less costly basis. Because if the government was to enforce the provisions of the 1961 Apprenticeship Act, which calls for 2.5% to 10% of workforce being apprentices, then I think they could solve a huge problem of a mismatch between skilling and industry demand, because companies which give apprentices would obviously give them in areas where they see future opportunities. So that's something that the government could promote by offering a greater government support to industries, offering apprenticeships, and to also take away any compliance burden, as it were. Not compliance burden, but to take away any sort of inspector Raj sort of attributes of implementing the scheme.
Rajiv Kumar, Niti Ayog there. Let's get another voice. Former Chief Economic Advisor Arvind Virmani is of the view that timely justice and rule of law is crucial for any economy. Listen to this conversation that we had with him earlier today.
I think, I have been arguing for it for the last 10 years at least. I wrote it in a paper in 2002, which was published in EPW. I was happy that, this whole issue of judicial, legal, police reform is coming, because people have traditionally in their minds separated out economics from these sort of issues of personal safety and security. But a market structure which we assume depends on the rule of law. The kind of free market or democratic market structure is fundamentally based on the rule of law. And I think not enough economists, probably because they are trained in Marxian economics, too many of our economists know Marxist economics more than market economics. But judicial reform, police reform is kind of the foundation on which markets are built, free and competitive markets. I mean, you can always have some kind of a market, a monopoly. So I was quite happy at that.
All right, those were two big voices, one on the jobs debate, the other on some of the legal and judicial issues raised by the economic survey. The more immediate concern continues to be of the bond markets. Now, yesterday, the bond markets again reacted very badly, partly perhaps to the economic survey's comments on a pause in fiscal consolidation, partly perhaps to higher global yields. This morning, our markets looking a little bit quieter. Let's get a veteran voice in. Jayesh Mehta is joining us with his thoughts on what is impacting the markets, Bank of America, Merrill Lynch. Mr. Mehta, what happened yesterday? What now? What are the markets worried about now?
No, I think, one is, of course, economic survey, which, if you look at month on month, people do try to see what's the fiscal gap and the borrowing, right? So in last 3 years, if you look at 17, 18, assuming even if they don't do anything right now, but when you do month on month, you are at the highest in last 3 years in terms of borrowing, right? And to add with that, if the trend, even if the same continues for next year, it becomes really difficult to match the demand supply. And if you look at what has happened is from 2009, towards 2008, we were going to lower fiscal deficit, but then almost touching the FRBM of 3%, but because in 2009 we went ahead with more borrowing, typically that excess supply or the normal demand, which is banks, insurance, a little bit of mutual fund and provident fund, was always absorbed either by RBI OMO purchase or foreigners in the FPI limit. Now, unfortunately, this year the limits are more or less full for government bonds and very nominal limits available. So that's not helping us. And instead of RBI OMO purchase, for whatever reason, we had OMO sales, which is almost like 0.5% of fiscal deficit, right, in 17, 18. So that oversupply has really disturbed the market. And of course, banks, particularly, major players are Indian banks, almost dominant to 60% of the borrowing, right? And they are actually sitting on a lot of mark-to-market losses. The risk appetite for people is not there at this juncture.
Jayesh, hi, this is Harsha joining in this conversation. Just want to understand, the nervousness is quite palpable over the last couple of weeks, right? From the time that borrowing number came out and the borrowing was cut. You've seen the nervousness in the market pretty much every single day. Paint for us the best case and the worst case scenario after the budget. What would be the best case scenario for the bond markets, and what would be the worst case?
I think we have gone into a rut, so we are not looking at any immediate ratification of what has happened, because even if you markets assuming 3.6 or something like as fiscal deficit, even if they give 3.2, markets will not agree with the math, saying that the math does not match, right? So it has now gone into a mode where, they will look at negative for everything, right? So from that perspective, I don't see an immediate relief coming in, maybe 10, 15 basis point. Can it trace back? Yes, it's a very thin market at this juncture. So it can trace back, but do we really see dramatic change where it goes below 7% or so? Looks difficult. Will it breach 8%? That also looks difficult. But at this juncture, I think the mood and the sentiment is extremely, extremely bearish. Like every day you see the newspaper, U.S. yields are higher, your borrowing is higher, your oil price is high, and there was some thought of people expecting some relief from RBI in terms of mark-to-market, spread over, stuff like that. And that's also not going to come through. So from that perspective, demand supply, till people get a hang of it, it will go through that pain.
Mr. Mehta, what are you thinking that the borrowing number in the budget could come at? I think there was a Bloomberg survey which had suggested about 6.5 lakh crore gross borrowing, sir.
I think we are looking at maybe 6,80,000, looking at the current month-on-month trend.
Okay.
So I think it is absolutely, whether it's 6.5 or 7, it does not matter, right? I think it's a demand-supply mismatch. Where is that new buyer going to come through, right? A bank, even forget the mark-to-market loss, and for a moment you forget the sentiments about it, right? If you look at the overall demand supply between banks, insurance, they are the two large buyers, and the supply, which the government plans to do it, there has to be some other player which needs to come in, which typically till now, if you look at every year, is either the FPI or RBI. So at some point of time, RBI, will have to come back with OMO purchases, and at the time the market will turn around.
Mr. Mehta, one last quick question. US yields are also rising. We are again starting to talk talk around 3% 10-year yield. Is that having a bearing on the domestic market, sir?
That does, but I don't think, but that is, we have almost come from like, okay, US yield moved from 240 to 270, right? And maybe go to 280 or 3%. We have moved from 660, 640 was August 17. Maybe 660 is, you can say, normal average. We have moved from 660 to 760. So it's almost 100 basis point move we have already done, right? So I think ours is a more local problem on demand supply rather than, I would say, US at this juncture.
All right, Jayesh, we'll leave it there. Thank you so much indeed for joining us with your views. Jayesh Mehta from Bank of America, Merrill Lynch, talking about the bond markets and how they've been reacting to pre-budget jitters. Slip into a short break on that note. On the other side, we're going to be discussing the pros and cons of fiscal targeting with former RBI Governor Bimal Jalan. Don't miss that conversation on the other side.